All right, so we're looking at example 1 from the Excel files on right here on FOL. So we've got the chapter 17 examples. So I'll just walk you through a couple of them just for some background, and then it's a lot of repetition after that. All right, so let's look at example 1, where we have this company that signed a non-renewable, non-cancelable lease agreement to lease robotic equipment from Belmont. And the following information concerns the lease agreement. So we're told when it was started, how many years, what's the fair value as of that point in time, what's the economic life of the leased equipment, what's the annual rental payments, is there purchase at the end, bargain purchase option says none, straight line, no residual method, and Elmer's incremental borrowing rate is 7%. So the first thing we need to do is determine the present value of the lease. Okay, so we pull up our present value components. Yep, I need to enable editing. Here we go. We'll pull up our present value components, and I'll just walk you through this. So we have a 7% rate. Okay, so we'll connect that to our 7% rate. Number of years, it's the 5-year lease term. Our payment, okay, our payment would be calculated based on what we are told, 53,702, so I can connect it to that. Our future value would be 0 because there's no amount due at the end. It's a straight 5-year lease. And type 1 is based on when the payments are made, okay, which is at the beginning. So then our present value, and I just realized it didn't copy the formula over for me. Okay, so let's pull that up. So it equals the present value of, what's our rate? We have number of periods, what's our payment, what's our future value, what's our type. So we can use Excel. Okay. And that gives us a present value of 235,602. All right, so that's our present value of the lease. Now we need to prepare the amortization schedule. So our amortization schedule will have various information. Okay, let's put it over here so it's all on the same screen. We will have our original dates. Okay, so we have our multiple years, and we have our opening carrying value. And then the first payment is due on that same day. So our first payment is the 53,702. We know there's no interest because it's made on the same day. Therefore, it's all going to principal. So our carrying value drops immediately down to 181,900. And I'm just thinking, yeah, let's round this so it doesn't have any decimals. Round comma 0. And then that way we don't have to worry about any decimals. All right. Then we move forward. Our payments are the same amount each year. Okay, so we have 5 payments. And then we need to calculate our interest component. Our interest component is tied to the interest rate used based on our incremental borrowing rate. So we have a rate of 7%. And the 7% is calculated based on the opening carrying value. And it's a full year. So we have 12,733, which is 7% of 181,900. Our principal portion, which I just realized has a spelling mistake, would be the difference of our full payment less the effective interest. And then our carrying value would drop down to 140,931. We're going to fix that to absolute. We can then copy down our interest, copy down our principal, copy down our carrying value. Do that again for all 5 years. And you can see, well, it looks like there's some rounding in here, but we'll ignore that. But it's down to a 0 balance at the end of the 5-year cycle. Okay, so just to recap, our payments are fixed. Our carrying value opened based on the present value is reduced by the principal portion. First one has no interest. Second one, we have to calculate 7% of the 181. Next year, it's 7% of the 140, 7% of the 97, 7% of the 50,000. Moving on to journal entries for the lessee, so the person that borrowed the journal entries. Let's put them over here. So our first journal entry is when we bought the asset. We need to set up the right of use asset. We don't actually have the asset, but we have the right to use it. And we have a lease liability. So in this case, it's for the original present value of $235,602. We made a payment that very first day. That'll reduce our lease liability and come from cash. And the amount of our payment was $53,702. Moving forward to the end of the fiscal year. Okay, so let's go to December 31st. We need to depreciate the asset, and we'll have accumulated depreciation. Okay, and how we get that would be the value of the asset in 235. Let's use this one, doesn't really matter. We have the years, which we had 5. So annual amount would be 235 divided by 5 because it's a straight line. So we're just going to round that to 47,120. Okay. We have our depreciation. The next item is on December 31st. We also need to record our interest expense. And we'll add it to our lease liability. I personally don't like that. I would probably put this to interest payable, to be honest. I know the solution says lease liability, but you should never really touch a lease liability account. That's my opinion. So that we would accrue at the end of December the amount of interest being paid the next day. That would be your 12,733. And then on the next day, on January 1st, we would pay off our interest payable. We would then reduce our lease liability, and we would credit our cash. So our total cash going out would be the 53,702. Our interest payable, we would clear out the 12,733, and then we'd have the 40,969 coming out of our lease liability. So that matches all our amortization. And this would repeat. Let's do one more year. It's looking for year 3. So then at the end of year 3, we would also have another depreciation expense for the same amount because it's straight line. And we would have another interest expense, which would now be the 9,865. And that would be your first 2 years of payments.